Hello everyone, this is Var Sarmiento and today is Friday, October the 29th. If I sound weird, I just have to say that I guarantee that it is Juan Sarmiento. I just have a cold, the first in many years, but that's why I have a terrible voice. But please bear with me, I will go through this anyway. Let's go through the positions we have, and I'm looking for trades that need to roll over or anything. This is Apple. My position is kind of bullish right now, but I think it will go still higher, so I'm going to hold on to my position the way it is. Okay, let's go to ABT. Same thing, no need to change anything. The expiration is November the 19th. Same with COP, November the 19th is the expiration, so we have plenty of times to do what I need to do. Okay, this is CRM. Now here, you remember last week with the rollover of the call shares of the options, the call options to November the 26th. And October the 29th is today, and these puts are due to expire at the end of the day. So all I have to do is sell puts here. So I'm going to sell one put at the November expiration, same strike price, okay? Because this will expire, and if it did, then it will look like this. But with the put over here, it looks more bullish. Okay, remember, we want delta that is positive, slightly positive. It doesn't need to be more than 29, 30, 35, 40. If it goes to 100, then I begin to think that needs to be modified. The trade needs to be modified. We could also sell calls, but first let's sell our put here. Okay, so we can also yeah, there it is. Okay, so you can see that the stock is moved above my smiley face here, the apex here, which is about 290, and it's 297. So what I could do is roll up one of my calls. It is the outstanding call, and to get the outstanding call, all you have to do is subtract the short call from the long calls. So 2 minus 1 equals 1, so we have one outstanding call that we want to roll up. So I say analyze rolling, so I'm rolling up only one, and it would be the same expiration but a different strike price, more around 295 to 300. I suspect that the 295 wouldn't be available, and it is not. That's why it says not traded. So let's go to 290 to 300. Yeah, and then we get a credit. But we also need to change the expiration to the same as the option that we are selling. And so we reduce our delta to come close to delta neutral, slightly positive, and we get 1945, which is times 100 is $1,942. This is reduces our money in the trade, and we can use it for other trades. Okay, and if this stock suddenly begins to drop, so much the better. But if it goes higher, that would be good too. Okay, and here when it is, and I think it's toppy right now, it's at an all-time high. Okay, what if it falls? That's CRM or Salesforce. Let's move on to Lowe's. Lowe's is also reaching a new high. Okay, let's go to the Analyze tab. And here we have our deltas 22, that's fine. Okay, it's not too big. And you can see that we have 2 long calls and 2 short calls. They neutralize each other, but I have one here at 220. We could roll this up now to 230 or 240 if you wanted to. Let's see what the result would that be. I would like to see my deltas being still positive. Okay, so let's make sure that they're the same date, but first let's change the strike price to 230, could be 240, and change the date back to January 21st. Perfect. And we have a 9.8 delta. Not too bad. If you did it to 140, then my delta will be negative. I don't want that. I want it to still be positive. Okay, just very slightly positive, that's fine. And then send that off. And we're gonna get $665 credit minus commission. Let's move on to Oracle. Nothing to do here. We're still within the cone here, which means we are making money on the sideways, or would be making money as we approach expiration, which is November 12th. A long way to go to that. Still 2 weeks, 3 weeks. Yeah, 2 weeks. So next week we'll deal with that. Let's go to WFC. Same thing, expiration is November 12th, so there's 14 days to go. Let's look at the risk graph. That looks great. You could even close this position because the volatility has increased, and even though the stock hasn't moved at all, we have $1,100 in profits. So the volatility jumped a bit. You see, that's why you wanna enter your position at a low point in the volatility. So a little spike makes money. Okay? So what do we do? Do we get out? No, I want to stay on it. You could get out. I'm gonna leave it, but it wouldn't be too bad to take some profits here. How about if we sell half the position? Okay, so let's put 5 and modify that custom, and we're going to sell 10 and buy back 5. So that's a way to take profits, volatility profits, but we still consider the volatility to be fairly low, so it could still go, look, it has gone in the past to 55, and that would be great, okay? And it didn't take much of a pullback for it to spike in the volatility, and then you get more profits. So let's leave it like that, because the volatility, despite of the gains we've had, is still low, relatively speaking. Consider the rest of the year, that's a low volatility, okay? What matters is the volatility of this particular stock compared to itself. You don't need to go considering what is low volatility in the overall market. What matters is here in this chart, okay, which is comparing to the yearly volatility. It could go to 55, it could stay here, okay? That's what you have to think. All right, let's see what trades I have for today. I have TER, Teradyne, I presume, and UPS. Let's take a look at Teradyne. Let's copy the trade here. And of course, I have created this, so I will have to show you how to do that. Okay, let's unlock. And you can see the volatility is 36, 34. That looks like the volatility of the front of the back month is higher than the volatility of the front month. We need to evaluate that. Is that a good idea? It doesn't look too good to me, but let's see. First, the earnings. You can get the earnings from the chart. Okay, in the chart you have the earnings. If you don't have, please ask your broker how to generate that. Okay, I'm not going to waste too much time on that. But yeah, I make sure that I can display that here every time, and then it shows me when the earnings occurred and what is the estimate versus actual. Okay, that's where I get it. So the actual is what it really happened, 1.59 versus 1.44, difference 10%. That's good. 10% is a trade. Okay, it gives me the go ahead with the trade. That's one of the items. The other item is the volatility skew. Let's go to the Analyze tab again. This is the proposed trade, and I have the front month options. I'm gonna see the volatility right here, and I'm gonna enter it here. Okay, for the calls 36.17. I'm copying this number here now at the bottom right corner of your screen. Okay, and 35.12. It changes fast, so it will be okay. Just do the best job you can. Copy those, and then it gives you the difference. The average volatility from the back month is 35.6, the front month 32.04. Look at the chart. Is it a low volatility? Yeah, it is low compared to the rest, so that doesn't bother me too much, okay? But let's continue on. There are other items here. The liquidity. When we say buy the trade, you say create duplicate, and that gives you the mid and the natural. Those are the numbers by which we calculate liquidity. Okay, so the prices are mid price 43.9 versus 44.9. The difference is 2.2%. That means it is liquid enough. How do I figure that? Because the distance between the mid and the natural tells you, okay, a lot of people are trading this. If it is a small percentage, that the price is fairly fair. If that is too big, then you don't want to trade. But as it is, yeah, that's a trade. Then the current Iv percentile, you go to the trade tab, make sure you put TER or Teradyne, and go down where it says today's options statistics, and it says 11%. That's great. Anything below 15 is great. Okay, that means that the Iv is very low, and again, it's compared to itself on the year. Okay, so this is 11% from the lowest point. That's what it means. Here at the bottom right corner of your screen, where I have my arrows flipping here, okay, that means that it's low compared to the rest of the year. It has been as high as 58. Wouldn't that be nice if it went back there? Because your volatility would increase your profits as well. Okay, so the only thing that concerns me here is the differential, the volatility skew. It's a little too low in the front month. That means we're selling expensive options, but we're buying even more expensive options. They're at 35. But for this stock, you see it here at the bottom of the range, so that's not too bad. So I usually say, well, I have 3 out of 4. That's good. Okay. All right. So then we calculate how much can I trade? Well, 10% of my account will be 8,677 is 10% of my account value. Okay, that's what I can do. And in this case, it will be two lots. You see, I have a 200. Well, I go to the Analyze tab and I create duplicate to confirm and send to see the actual price. Go to the multiple accounts, and you see here you have a 1 is 4,390. The buying power effect is how much money you must have in order to do this trade. So if I click the plus, that's 2, that's 87. That's very close to 10% of my account. So I'm willing to do that. Let's send that off. Okay, and we wait until it gets done, and it did right away. So it means it's liquid. It was liquid enough. Okay, let's go to this second trade that I have for you today is UPS. Let's copy the trade, and we're gonna go through the same process. Copy that. And again, I created the trade in advance, and it's not that difficult. But I can paste it here and analyze tab. Okay, if you want to create this, go to UBS first of all. Okay, add simulated trades. Okay, so here we say, okay, we have the long portion must be, let's see, instead of putting all, let's put 10. Okay, so we're going to go to 90 days or more. Okay, we would have to go to March. January is 84 days, not good enough. And we're going to buy 2 calls and 2 puts at the strike price that is closest to my current stock price, which is 215. Okay, I prefer actually 210. Okay, it's a little lower. Okay, so here we go. Press the control key and you click on the ask, and that gives me 1 call. Okay, we're gonna buy 2, so press the control key again and go click on the ask, and that created 2. Now we go to the put side, and again 210, we're gonna go ask because we're buying. Press it twice, and there you have, that's a 2 straddles on the long term options, but we're gonna sell 1 closest to 30 days. You can go 35, it might be cheaper. Let's go with the 28. Press the control key again. This time we're gonna press once on the bid here, again 210, and 210 for the put, and then that's my trade. Okay, you could choose to do further. Remember that we had this November, but how about the December? Would that be better? Well, perhaps not. Let's right click and then we say analyze trade, and then we change the November to December the 3rd. And that should be cheaper. Okay, and then you see, is it really better? Perhaps the skew is better. Okay, let's go to the sheet here. And let's make sure that all of our indicators here are good. Let's start with, let me go to UBS. Where is it? Here. Here it is, UBS. So the first thing we need to do is look at the chart and look at the earnings. 271 versus 252. Okay, 271 versus 252. It is 7.5%. That's a little below. It's not 10%, but it's still, the stock has moved very strongly, so that's good. Okay, I don't like that, but it's not the only thing. 7.5 is respectable increase in the company's expectations. Okay, so let's move on to the volatility skill. Let's go to the analyze tab, and here you copy those, but now we have 2 to analyze. So copy those and paste them here separately. And so we do the first one here, 2460. 24.6 versus 24.81, and the front month options 19.9, 22.40, and of course these are the same. And here we have the front month 21.32, 22.47, and obviously is better. It is at a more acceptable trade. Here this is not acceptable. Okay, the volatility is simply too low on the front month. Here is a little better. Okay, so we could do the second month. Okay, the December 3rd here, the second option. So let's delete that. Keep the one we're gonna do. All right, and the liquidity. We say create duplicate. And we have the mid and the natural. Okay, liquidity. It should be okay because this is a big stock, big company. And it is. Okay, it's less than 3%, so that's a go. Let's go to the chart. See, the volatility is declining still, so that looks good. It's at the lower end, but it might be a little too high. Let's see. Let's go to the trade tab and look options statistics, and it says 16. That's very close to my limit, 15%. So I'd say let's go for it. All right. %15 is so close. That doesn't bother me at all. This is trade. This one won't work. So we have to copy this. And yeah, so we're going to trade it despite the 2 strikes against it, okay? And then we have to decide how many lots we are going to do. Okay, create duplicate, confirm and send, and it gives you $4,000. Okay, if I buy 2 lots, it will be $8,000, which is below my 10% of my account. Let's select my account again. It's 8,000. That's 10%. Less than 10%, than 86,000. Confirm and send. And we wait until it gets filled. I'm sure it will get filled before the end of the day. If not, I will adjust the bid to make sure that it does get filled. Right now it's above the current price, and the current price is declining a little bit, so it should get filled shortly. Okay, so that's all for today. Thank you very much for joining me, and see you next time. By the way, I'm planning more basics of options series, so be on the lookout for that. I will be in a separate playlist. So I'm going to start from what is a call, what is an option, to get into the Gini trade, okay, and everything in between. So make sure you post your questions so that we can discuss and I could make my videos according to that. Thank you very much for joining me. See you next time. Bye-bye.